Guys, the three different types of insurance. One is going to be term insurance. We'll give you guys a definition, but for today's purposes, we've actually separated universal life and whole life insurance. Oftentimes, those two get kind of clumped together under one category. I'm not a big fan of that. They call it permanent insurance. And as you start to understand this product, you will quickly realize that universal life is anything but permanent. So that's why we've designated the three today. So, Anthony, tell us a little bit about term insurance.
Term insurance is the most common form of insurance. And I would say, in essence, this is more of the pure insurance.
Yeah.
Right. We're not building any equity. There's no cash value. We're going to pay a minimum premium for a certain amount of death benefit for a certain amount of time. I equate this to more like renting, right? If you want to rent a house, it's easier to get in. Typically your monthly payment is going to be less, and you have that. Your lease is locked up for a certain period of time, and then when the lease is over, either you need to get out, right? Or if you stay in, the rent is going to go up. So very similar with term. You have a fixed premium for a certain period of time, and that can typically range from 10, 15, 20, or 30 years. Obviously, the longer the term, more the risk there is on the insurance company. Thus, that's reflected in a higher premium. I will say we don't talk a lot about term insurance, but I do want to, we're both proponents of it. We have term insurance policies. And in fact, I even just got a new term on my wife a year or two ago. And so typically the main purposes of term is to protect the family. If something were to happen, this can help replace the income or maybe help achieve some legacy goals. Also, and another reason to get it is we lock in your insurability, meaning you have that, say you have $1 million of term insurance, you can convert that into whole life no matter what your health situation is. So we got it for really both of those reasons. For one, we have some legacy goals that we want to meet, but also, you know what I found, Cameron, and you're going to feel this if you haven't already, but as we get older, we have a tendency to age, meaning we start feeling older, we start having to pay more attention to our blood work. Like I've even said on the podcast before, I always thought a PSA was like a public service announcement, and honestly, some of those, the good ones are like very touching, right? Now at my age, PSA has a different meaning and it's touching, but in a very different way. Okay. But all I'm just saying is that we have a tendency, our blood work, cholesterol, things start working as well. And our level of health declines. And so the health rating could be different. So we're locking in our health rating.
That was interesting. That was interesting. In regards to aging, I don't know what you're talking about. I am in my prime. As good as it gets. Fasto, I was going to talk about universal life insurance and introduce that to our audience. Guys, if you've been around at all, you have come across universal life in some way, some form. And a lot of times I'll have conversations with clients about the differences between universal life and whole life. And I'm going to give you a little bit of background on universal life because I think it helps people understand the way that product is actually going to perform for you or supposedly perform for you. Universal life came out in the late 70s and early 80s. And if you remember what was happening back then is you had a whole bunch of money that was kind of flooding into the stock market. And so the stock market was going sky high. And so there was a bunch of smart bankers, product developers that said, hey, I would love to have market returns under the umbrella of insurance because we get tax-free growth. And so what came about was a universal life product. And so what they have is they actually have two pieces to this policy or this product. One of them is going to be the cash value accumulation side. And what they do with that is they actually attach it to an index. And so it can mirror an index. So usually you got a floor, you've got a ceiling. And so if the market goes up, that account value will follow that up to a certain point. If it falls down or goes down to zero, it'll stop there. And so they've got this window or corridor of performance on the cash value side. That side's not too bad. The kind of Trojan horse, in my opinion, of the where they went wrong in product design is on the insurance side to the universal life. What they did is they paired an annual renewable term policy with that product to pair those two together. So you've got an annual renewable term policy with a cash value function mirroring an index. That's what the universal life product is. And guys, this is where it kind of gets misleading to people, is because when someone shows you a universal life illustration when you're young and healthy, right, the cost of insurance is actually very small and very minimal. Mm-hmm. But what we know with term insurance is that as we age, like Faso was referring to earlier, that cost of insurance increases every single year. And so with the universal life policy, insurance companies are obligated to cover you. But when you look at an illustration when somebody's 60, 65 years old, the insurance company is covering for you for the amount of insurance that's in there. But man, that cost is skyrocketing each and every year. And so the game that's being played inside of that product is that the market returns are going to outpace that cost of insurance. If you start digging into the illustration and you start looking at age 60, 65, you'll see some notifications on that illustration that'll say lapse, it'll say zero. And so that is a warning sign to, hey, if we don't get the proper returns inside this product, this thing could lapse, it could blow up in our face. And so that is a little bit of history on the universal life product.
Well done, Cam.
Thanks. Anthony, tell them about whole life insurance.
Whole life, whole life has been around literally over 200 years. I think when we go into the history, I think the first one was in the 1700s.
Wow.
I believe. But in essence, I would say whole life is more like buying your insurance, where it's going to take the premium or the funding is going to be a little higher. However, it's never going to expire like a term insurance. And also there's going to be some cash value or some equity in there, which that's why we like to use it for infinite banking. And that's what we leverage against is the cash value. And in the real simplest terms, whole life is more like reverse engineered for the death benefit. A little interesting fact, the way those policies are designed, the guaranteed cash value is going to equal the death benefit at the time of maturity. And depending on the policy, that maturity may be age 100 or age 121. If you were to look down at a whole life illustration, and those numbers are going to be equal. So, what that means is each year we're getting more and more equity. So the gap between the cash value and the death benefit is getting smaller and smaller. So I would say whole life is more like buying a house. Your premiums are fixed, but also with whole life, there's additional riders that we can add that will amplify the cash value, and that's what we use in the form of paid up additions, or we commonly call PUAs.
Great explanation. I want to point out real quick before we move on is just the difference in how long these products have been around. Man, with whole life insurance, we're almost looking at 200 years, right? With universal life insurance, man, what are we, 50 years, right? And so there's a big difference as far as kind of how these insurance companies, the track record that they have with both of these products. Universal life is very new, and I think we're seeing some of the downsides to this as you start to do some research. So,
and I would say in the simplest terms, the biggest difference is who's taking on the risk.
Great point. Yeah.
On a whole life policy, the insurance company is taking on that risk, because there is a guaranteed cash value, guaranteed death benefit. So they need to make their investments and keep their expenses in line. And if they don't, the company is the one that's on the hook. And index universal life is very different, where the insurance company takes very minimal risk. Their risk is only for the death benefit, and they're getting compensated accordingly on that 1 year term insurance. But where the cash value goes up, or it can go down, and we're going to talk about that in a second. that's all on the responsibility of the insured.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.